Hello everyone, my name is Nrupin and in this video we will take a look on investing method of William O'Neill, who as per my personal opinion is world's greatest techno-fundamental investor. In this video I will try to give you a small description of his book, How to Make Money in Stocks, a Complete Investing System, in which he describes his growth investing system, CanSlim. The basic investing ideology of William O'Neill was invest in growth of business, not on baseless ratios and numbers. From his book, I learned why PE is possibly the most useless number on which investors try to invest. His statement, a great deal of PE analysis is based on personal opinions and theories that have handed down through years by analysts, academians, and others whose track record when it comes to making money in the market are both questionable and undocumented. To say a company is undervalued because at one time it was selling at 22 times earning and it can be bought for 15 is ridiculous and somehow naive. Pretty much makes looks everyone who keeps talking about PE bonkers, because his own performance as investor enabled him to be the youngest investor to buy a seat on Wall Street. His book helped me understand almost all methods of investing that involves PE in them are weaker form of investing methods, because almost everything about PE is theoretical and I should stop looking at PE no matter how I want to invest. His idea of investing is simple: invest in growth of business, because growth of business leads to increased earnings and increased earnings lead to increase in stock prices. I took his advice of throwing PE out of window and started looking for businesses with earning potential. At present, my investing method focuses just on earning potential and I am very happy with kind of results I am getting with it. Before we take a look on CanSlim, here are some mistakes which, as per him, majority of investors make and suffer losses. Focusing only on when to buy without any idea about when to sell. Taking action on immature buy signals in greed of more profit and thus ending up with nothing more than loss. Fearing to exit position in loss only to make more losses. Not following your sell rules in greed of more profit. Crying over losses that you never made in market, and finally buying second-rate stocks because they are value stocks. He admitted he also made similar mistakes with very brutally honest attitude. CanSlim is hard rule investing method, which means none of the rules that are listed in CanSlim should be broken while investing to use it to its maximum potential. CanSlim is actually acronym of list of attributes that a great growth company possesses to outperform rest of the market. As per Will, you cannot invest as growth investor without learning charts. All growth stocks show similar kind of price volume activity. And to prove his point, he has compiled a list of more than 100 growth stocks from history. You can take a look on them in his book. A growth business always forms a consolidation pattern before exhibiting upside. As per Will, cup with handle, saucer, flat bases, ascending bases, high tide flags, liner bases, and double bottoms are most trustworthy chart patterns when it comes to reflect successful consolidation. Once stock matches CanSlim criteria on fundamental front, stock must also show any one of these chart patterns. C in CanSlim represents current quarterly earnings and says should be increasing. As per Will, to qualify first rule of CanSlim, a stock must show increase in quarterly earnings. For example, Q3 earnings of 2017 should be greater than Q3 earnings of 2016, and minimum growth should be 18 to 20% or more. As per Will, 5 to 10% growth is insufficient to trigger any good upward momentum. Again, you must not compare current quarter's earning with last quarter's earning, which means Q3 earnings of 2017 should not be compared with Q2 earnings of 2017. Also make sure that accelerating earnings should be supported by accelerated sales. If earnings are increasing but sales are not, then there is something fishy going on and it is a warning signal. So C tells us current quarterly earnings per share should show increase of minimum 18 to 20% followed by net increase in total revenue. A in canceling represent increase in annual earnings. As per Will, company should annually grow at least by 25%. As per his study of growth stocks, successful growth stocks show minimum 36% increase per year. As per him, minimum return on equity for last 3 years should be 17%. Consistency is everything. Unless stock shows more than 17% ROE for 3 years without fail, it will not qualify for second rule of cancelling. He advises to look for minimum 20 to 25% ROE each year. N in cancelling represents new management, new product, new expansion plans and new consolidation patterns. Stock prices cannot rally up if there isn't anything new to drive prices up. As per Will, a company should bring something new to the table, either it be new management, new product or new expansion plan. If company fulfills something new criteria, then you will see a new consolidation pattern forming on price chart. You have to purchase stock as soon as stock breaks out of consolidation. S stands for less supply and more demand. The stock should have less number of outstanding shares because less outstanding shares increase liquidity, which help prices rise and fall quickly. To avoid loss due to liquidity, look for company in which company owners and management have held majority of stocks. In today's scenario, this information is not easy to get. Better have a strict selling rule. If stock goes excessive splits, then supply will increase, which might lead prices down. So it is better to liquidate your position if company declares 3 for 1 or 5 for 1 stock splits. Same doesn't apply for 2 for 1 stock splits. Stock should have low debt to equity ratio to justify supply and demand of its shares. A stock with high debt to equity have huge risk associated with it. Aggressive companies are not worth buying if they can't manage their debt. L in cancelling stands for leader or laggard. Leader doesn't mean the biggest company. A leader stock is one which not only outperforms the market but also other stocks in its industry. To know your stock is leader or not, compare it to industry index and other stocks of industry that are outperforming index. Honestly, I would recommend not to go in hassle of comparing your stock with every other stock in industry. If it is outperforming industry index and it also matches other criteria, you should buy it. And the reason I am recommending this because a good comparison can take a very long time. Growth stocks have tendency to move faster. So if you will be spending a lot of time to conduct proper comparison, you will miss the right price to purchase. Having a stock that is better than good but less than best is a lot better than having none of them. I stands for institutional ownership. Will insists that stock you are buying should be held by few reputed institutions. Institutions means mutual funds, hedge funds or wealth management firms. And these institutions should have proven record of performance. The reason for this is in spite of the fact that there are thousands of stocks in stock market, almost each stock has passed eyes of some institution. If a stock doesn't have institutional ownership, it means that company has been rejected from the best guys of business. There are 100% chances that everyone who rejected that stock might be wrong, but while growth investing for any reason, we do not prefer to take any risk. M in cancelling stands for market direction. Will says you should only enter market when it is on bull. You should book profits and wait for new bull market to reinvest your money if market turns direction and goes bear. After stock qualifies all letters of cancelling, it is time to check which of his favorite consolidation pattern has formed over price chart. He emphasizes that you should buy stock as soon as it breaks consolidation. By the way, he would sell stock immediately if prices of stock would fall 8% within same week. Though this was a good condition then, it can't be applied to today's market scenario. You are advised to devise your own selling rule before you put this method into action. He would sell if stock would generate 20% upside within 3 months. On other hand, if stock would create 20% upside in a month, he would hold that stock for more than 3 months expecting multi-bagger gains. Now advantages of his method is that it helps you find best growth stocks and keeps you invested in best performers. People who have managed to find stocks that match CanSlim has multiplied their money from 3-fold to 10-fold in a single year. Will advocated for concentrated portfolio in which he would focus on keeping only best performing stocks and removing underperformers. Will would remove all those stocks from his portfolio which would fail to perform more than 20% in 3 months. His portfolio strategy was strict. If stock doesn't perform as per his rules, then he would say goodbye to them and focus on highest performers. This helped Will pocket big profits with help of small number of stocks in portfolio in which all stocks would seem to be performing like crazy. The disadvantage of his method is that it is extremely difficult to find stocks that really match all conditions set by Will O'Neill. In any given market, there are hardly 10 to 15 stocks that can match all conditions set by Will, and if you fail to find them in time, you most likely would also miss opportunity to invest in them. CanSlim is hard rule investing method, which means if stock fails to meet even one condition, stock will fail to qualify for investment. Now Will's investing model works because it is very practical. If a business is earning more and becoming bigger every single day, there is no reason why its stock prices will not start moving up. For example, here's chart of Porval Industries. Porval Industries is ideological match to Will's investing method. Finding mathematical match is very difficult, therefore we will for now stick to this example. On technical front, Will advised to look for consolidation pattern aka base forming over 50-week EMA. To understand logic behind this, first you have to understand how technical analysis works. First, understand this. Technical analysis and trading on that technical analysis are two totally different skills. You may be able to analyze stocks technically, but you can trade or not is another question. To create chart setup, we follow specific steps. Step 1 is to select price theory that you want to use for your setup. Keep in mind all price theories in one form or other states one and the same thing and can be used with any method of analysis, only naming culture differs. Most popular price theory is Dow theory and it is widely used for indicator trading. I am also indicator trader, but I prefer price cycle theory. Price cycle theory is kind of very unknown price theory because its name collides with Hurst price cycle, and any search related to price cycle theory usually ends with Hurst cycle. Next is crowd psychology theory, specially used while pattern or candlestick trading, and finally Elliott wave theory, which is quite popular among geometric traders. Keep in mind any theory can be used with any method of trading. Popularity of theory specific to trading method does not change the final result of setup. And the reason for that is almost all price theories are in one form or other form are derivatives of economic cycle. Which means when you are trading price charts, you ain't really trading just price, you are trading levels of supply and demand. All indicators, all setups and all concepts of technical analysis are dedicated to help you trade economics working behind business. Economic cycles can be as small as 1 day to 1 hour and as long as weeks, months, years to decades. And therefore we have golden rule of techno-fundamental analysis. Technicals always follow fundamentals and it works irrespective of selected time frame because same is the case with economic cycles. When this came to my notice, I changed my fundamental investing method to match new theory of successful business with respect to economic cycle of business. Any stock that qualifies to be successful based on economic cycle of business matches qualities of a value as well as growth stock. Good part is it is easier to analyze stocks based on economic cycle of business than any other method of analysis. In case you want to learn how to analyze stocks based on its economic cycles, links are in description of this video. Contrary to what you believe, fundamental analysis is much easier than technical analysis. Now as per price cycle theory, price moves by forming price cycles. With respect to uptrend, first minus cycle is used to detect beginning of new upside. Trade is usually taken on second cycle and exit has to be made before trend ends or at the end of trend. Will stated if stock matches CanSlim criteria, then first let prices come above 50-week EMA and enter trades on formation of consolidation pattern. Now most consolidation patterns form as beginning of new price cycle, mostly at beginning of second minus cycle, from which we can say that if you found stock that matches all conditions of canceling, best place to enter position is first pattern break. Which brings us to Porval Industries. Now as per definition of uptrend, in an uptrend price moves up by creating and breaking newer resistances. Result is series of higher highs and higher lows. On chart you can see prices are moving up by creating and breaking newer resistances. Each new high is higher than previous high and each new low is higher than previous low. Whenever such conditions are formed, price usually start moving above 30 and 50-day EMA. Now we know prices do not move with 100% consensus to definitions and concepts. Therefore, we have to work with close matches. Therefore, the condition that prices must be above 50-week EMA defined condition required for uptrend. It included all conceptual close matches for fundamentally strong stocks with active uptrend. Next, he advised to enter consolidation pattern break, which means he advised to enter second cycle of uptrend. It also tells us, as per Cancelim model, the best place to invest is first pattern break. And as per ideological match, Porval Industries last week broke out of consolidation rectangle, also known as the liner base. The 50-week EMA marked beginning of uptrend, then came first consolidation pattern, which formed and broke above EMA. The first pattern break is best place to enter any stock that matches Will's investing ideology, because it automatically places you into second cycle, which again with respect to price cycle theory is best place to enter trades. So last week when Porval Industries broke its consolidation pattern, the entry price of 54 was best place to invest in it. Will's contribution to investing industry is that he helped investors understand why looking for all ratios and numbers is waste of time and irrelevant. He gave us growth investing model based on which we can build a very good investing method for ourselves. What I consider as his biggest contribution is his emphasis on having a selling rule. Because selling rule provides you idea about where and how profit should be booked and where you should be ready to book loss or less profit. Selling rules are something that help you pocket more than average profits. While creating my investing model, I took 3 elements from Will's model. First is earning, second is direction of price, and third is having a strict selling rule. Will's method would focus on buying stock at its high and selling higher. I also buy stocks at its 52-week high and sell it higher. And just as he would sell if stock would match selling rule, I also sell without hesitation if stock matches my selling rule. Finally, we can say that Will's investing method demanded very high level discipline, from which we can conclude that disciplined investing method helps you outperform market by a huge margin. It's no brainer that his students also made similar kind of profit as he made himself and also won several investing competitions. Finally, as I always say, no video is good enough to justify original work of any investor. To understand Will's method to its core, buy his book and learn from them. With that said, thanks for watching this video and have a nice day.